Imagine a farmer who owns only one type of crop, say wheat. If rainfall is good, he prospers. But if a drought occurs, his entire livelihood is at risk. Now imagine another farmer who grows wheat, rice, and vegetables, and also keeps some cattle. Even if drought reduces wheat yield, he still has rice, vegetables, and milk to rely on. The difference between the two farmers illustrates the essence of portfolio diversification, a strategy to reduce risk by spreading investments across different assets, sectors, and geographies.
Over 93% of traders lose money in the markets, not because of the market, but because of their mindset. Hi, I'm GC Sharma, founder of Ghar Ghar Investor, former head of financial education at the National Stock Exchange. After 3 decades in the markets, I'm here to help you trade with discipline, not emotion. Welcome to Bounce Back Trader, India's free YouTube learning series for traders who want to bounce back with clarity and confidence.
Portfolio diversification is the practice of investing in a mix of asset classes and securities to reduce the overall risk of the portfolio. Instead of relying on a single stock, bond, or asset type, diversification ensures that poor performance in one area does not devastate the entire portfolio. The underlying principle is simple: different assets react differently to the same economic event. By combining them, you reduce volatility and stabilize returns over time. Diversification works because of correlation. Correlation measures how two assets move relative to each other. If two assets are highly correlated, close to +1, they move in the same direction. If they are negatively correlated, close to -1, one rises when the other falls. A well-diversified portfolio combines assets with low or negative correlations. For example, when equity markets fall, bonds often rise, providing balance. Similarly, gold frequently acts as a safe haven during stock market downturns. 1. Risk reduction. The most obvious benefit is lowering unsystematic risk, company or sector-specific risk. 2. Smoother returns. Diversification reduces volatility, making returns more predictable. 3. Capital preservation. By avoiding concentration in a single asset, you prevent catastrophic losses. 4. Exposure to multiple growth opportunities. You participate in the growth of different sectors, asset classes, and geographies. Single stock versus portfolio. Suppose you invest all your money in one company. Say Reliance Industries. If Reliance faces regulatory hurdles, your entire wealth suffers. But if you hold Reliance along with Infosys, HDFC Bank, government bonds, and gold, a decline in Reliance can be offset by gains elsewhere. Global diversification. Indian investors in 2008 who also held US equities benefited because while Indian markets fell steeply, some international assets provided partial protection. In India, retail investors often over-concentrate their portfolios. Many invest only in bank FDs, or only in real estate, or only in a handful of domestic stocks. Such concentrated exposure increases vulnerability. For example, real estate prices in India stagnated between 2013 to 2019, hurting those who invested only in property. During COVID-19, equity markets crashed in early 2020, but gold surged, proving its role as a diversifier. Indian investors today have access to multiple instruments: mutual funds, ETFs, international funds, bonds, sovereign gold bonds, SGBs, and REITs that can create a truly diversified portfolio. 1. Asset allocation matters more than stock selection. Studies show that 80 to 90% of long-term returns are driven by asset allocation, not picking the right stock. 2. Don't over-diversify. Holding too many securities creates diversification, where benefits flatten out but costs increase. 2. Rebalance regularly. A portfolio drifts over time, equities may outperform and occupy a higher share than intended. Rebalancing restores balance. 3. Diversify across time horizons. Mix short-term liquid assets with long-term growth assets. 4. Think global. Don't restrict yourself to one geography. International exposure reduces domestic risks. Investing only in equities, believing that stocks always outperform, ignores the need for stability. Ignoring bonds and gold. Many young investors neglect bonds and gold, though both act as shock absorbers. Overconcentration in real estate. Culturally, Indians love property, but overexposure makes portfolios illiquid. Chasing past performance. Investors buy funds that performed well last year, ignoring that winners rotate. Diversification is not about maximizing returns, it is about optimizing risk-adjusted returns. A diversified portfolio may underperform the best performing asset in any given year, but over the long term it protects capital, reduces stress, and builds wealth steadily. Think of it as playing a marathon, not a sprint. Investors must shift from the get-rich-quick mentality to the stay invested and grow steadily mindset. Consider two investors in India during 2020. Investor A had all money in equities. When COVID hit, his portfolio fell by 35%. He panicked and sold at a loss. Investor B had 60% equities, 20% bonds, 10% gold, and 10% international ETFs. While his equities fell, gold and bonds cushioned the blow. His portfolio dropped only 12%, and by 2021 he had recovered faster. This case proves that diversification reduces emotional panic and prevents bad decisions. Diversification spreads investments across asset classes, sectors, and geographies. It works because of correlation. Different assets move differently. Benefits include risk reduction, smoother returns, and capital preservation. In India, access to mutual funds, ETFs, SGBs, and REITs makes diversification easier. Avoid common mistakes like overconcentration or chasing past winners. A diversified mindset prioritizes stability and consistency over short-term highs. Review your current portfolio and calculate how much is in equities, debt, gold, and real estate. Check if more than 40% is in one asset. If yes, diversify. Add at least one diversifier, like gold or bonds, if absent. Explore international funds for global exposure. Set a calendar reminder to rebalance your portfolio every year.
You've just completed another lesson of Bounce Back Trader. Remember, trade with discipline, not emotion. Subscribe to the channel, share your thoughts in the comments, and continue your journey in the next video. Let's change that 93% story.